analysis more logically proven. All right, so we try to be a logical investor. So it's not nothing that we just try to invest illogically all in all the times and here and there. So we want to use some tools that are controlled investment while we can still make some decent return, even we trade discretionary. All right, and usually discretionary tradings got higher return than systematic trading. So as you have if you have read the book, most of the systematic trading strategy are exploited. So, or it is there's no alpha for them to capture. So, but for discretionary, you may have some edge in your investment. Okay, so in the tutorial notes, you are asked to pick 6 companies in your calculation, and from the solution, you will find that they picked some 6 companies that are from different countries, and some of them are even delisted. All right, so that means they are not trading anymore. So these are the companies they have. Some companies are coming from Germany, some coming from the US, and some coming from India. And of course, Twitter now is no longer a tradable company, so it is delisted in 2022. I think that is privatized by Elon Musk. All right, so privatized by Elon Musk, and that's why it is no longer there. But anyway, so what we see here is that in discretionary traders, they're trying to do some financial statement analysis. All right, so that is to calculate the some earning per shares, PE ratio, and book to market ratio, and one of the most important numbers, dividends as well. All right, so because this is the return that are given by the companies, even the price is not moving. All right, even the price is not moving. It is something that you care about. All right, so the dividend, and so these are the numbers that we can extract from financial reports or from their annual report. And of course, in this case, you can see that the numbers are obsolete from historical data. So the earning per share from 2013, and we have the expected value for 2014. So it is like now, all right? So imagine that you're standing today and you're trying to do some analysis of a certain company. The best you can use is the financial report coming from the last quarter. All right, usually so the financial report comes quarterly with a small report, or they have a forward report annually. Excuse me. But the best report you have now is, of course, from last year's year end, and usually it is already published. Uh, Usually it takes a month or so to get published, but by now in mid March, you should expect that you can get a full financial statement that is audited by last year end, and that is why you can have let's say, all right, so we have the earning per shares that are exact or that are actual in 2023. Okay, 2023, and you do not have the number for 2024 yet. All right, because it is you don't have the crystal ball, and that is some by expectation. So you can use it by expectation, and so a better illustration is that I show you by using the data of Tesla. So it is prepared by Professor Shi, and he has already got some data from the data source. That is the Tesla. Okay, this is the financial statement for Tesla. So we read it column by column. All right, so that we have a financial year 2003 with a suffix A means that it is actual. Okay, it is actual, and we have already confirmed value, so it is audited. And so you can see for next columns, we've got a 2004, 24 E with suffix e means that it is expected, right? So it is estimation. It's estimated. We even have an estimation for 25, year 26, year 27. And these numbers are, of course, getting less and less trustworthy or less and less uncertain. Okay, so we have uncertainty with the numbers that are further and further away. And well, we have quite a good estimation for 2024 because we have already, by looking at the market, we can kind of get some sense about how the markets move. And at least we have 2 months of data by now. And well, of course, you should be getting a closer estimate than 2025, 26, or 27. So this is the case. And let's see what numbers we have extracted from the financial statement. One thing is the revenue. So this is the total revenue. And there are cost of sales that we have to pay in order to make this revenue. So that is so the gross profit. Okay, the gross profit is this value. So that is 17,660,000,000,000. So it is in million. And this is the gross profit. So we can calculate it by ourselves. So well, sometimes it is published and sometimes you have to calculate by yourself. But the revenues, the cost of sales, these are coming from the financial statement. And the operating expenses, operating income, it means that it is the gross profit, uh, subtract the operating expenses, and this is the operating income. And there is a tax provision. So how much tax we have to pay. And this tax is calculated from the tax rate, 11% in the US. Okay, so this is the tax you have to pay. And the net income is almost 8 billion. Okay, almost 8 billion. And there are some depreciation and amortization using the percentage in calculation. Okay, so it is using the percentage in calculation, and we expect that it is 6.2%. Or when we look at the financial statement, it tells us that how much depreciation and amortization is used. Okay, they use 6 billion, and in this case, our EBITDA. Okay, so EBITDA, earning before interest, tax, and depreciation, amortization is almost 15 billion. All right. And we can also read the capital expenses. So this is the capital expenses, different from the operating expenses. But I believe that you should have noticed from previous accounting units. Okay, you should be able to tell the difference between the operating expenses and capital expenses. And so there are some others that we use, and we finally get the free cash flow. Okay, so the free cash flow is 6.8 billion. All right. So this can be putting back into the business operation. This can be paid out as the dividends. So it depends on how they use. But anyway, so this is the free cash flow, or it means that it is the money that they can use in their next year business. All right. So this is the money. Okay. So this is the free money that they have. And we will be using, okay, so we'll be using these numbers to calculate the price, or we calculate the fair price of Tesla. Okay, so what we are doing now, well, 99% of the time in financial problems are related to pricing. All right, so if we use so here we can use discounted cash flow to find the price of a company, or we can use dividend discounting model to calculate the price of company. So if we have some expected dividends, all right. So there are many ways. Okay, so no matter we are pricing a companies, we pricing the risks. Okay, so even risk can be priced. So like in pricing derivatives. So pricing derivatives is essentially pricing risks. So we want to know how much people are willing to pay for risks. So that is the case that uh, different problems related to pricing. So we just keep on doing pricing. And next is that so we have completed the first column. So this first column is that the actual financial value. So we have calculated the revenue growth, the some ratios, some rates, okay, cost of sales in percentage of the revenue, operating expenses in percentage of revenue, tax, um, depreciation, amortization, capital expenses here and there. Okay, so these are all in percentage. And next, we are going to use some numbers to project, okay, or to find the estimation of the um, cash flow of next years, okay, or the coming years. So we expect that, well, Tesla is a quite a well-established company. It is in its stable stage, and we believe that the revenue growth will decrease by 2.5% year by year. So that's why we have 70.5%, 15%, 12.5%, and 10% here. All right, we believe that it is decreasing in revenue growth. And of course, if you're analyzing different companies, you may use different numbers. Perhaps if it is a starting new startup, all right, we will expect that the growth is much higher. Okay, so the growth may be higher. So every year it may be double digits and increase by 10% every year. And we believe that it may be sustainable in the coming near years. But for Tesla, we don't believe it is the case. All right, especially there are many other companies are making electronic cars and making electric cars, and that's why we believe that they're no longer having a strong growth in the future. Okay, so this is the discretionary part. It is by your analysis, your own feeling. All right, so or your connections. All right, perhaps you know some analysts that they have a superior information. They're very good at analyzing electronic cars, and that's why they give you these revenues. All right. So this is the discretionary part. All right. So it may not be accepted by everyone. All right. It is your own analysis. And next is that we filled in the remaining numbers. Okay, we believe that the cost of sales in percentage of revenue will be decreasing as well. Operating expenses decreasing as well. For the test, all right, because we do not see any new policies coming out, so we believe the tax will be kept at this level. All right, 11% for U.S. companies, and these amortizations and capital expenses, we just plug in our own numbers. All right, so this is the discretionary way of your analysis. All right, so you put your own numbers, and from that you can just go back to the numbers. Okay, so go back to the numbers in dollars and calculate your projections. All right, so expectation running here and there, and calculate the free cash flows. So the free cash flows will be in these numbers. All right, so this is what we expect in the future. All right, this is what we expect in the future. And we make use of these numbers to calculate the discounted cash flow. All right, so to calculate the discounted cash flow and the equity value, the company values will be this number. Excuse me. All right, and this is the case for the present value of the company. So we are trying to find the present value of the company. And so what it means is that we are trying to use the discounted cash flow method. Okay, so using discounted cash flow method, we are like finding the present value of the company by calculating the sum of the cash flow at different time, of course, and discounting it. So using the discount factor. All right, and we're summing the time, and it sums the time to infinity, so to perpetual, and that's why there's a terminal value for perpetual growth. All right, so we cannot do this expectation for all years to infinity, but we try to find the perpetual growth. So it is like a summing to infinity. Anyway, so the idea is to discount all the future income and find the present value of our company. And this is one way that you can use to find a fair price of a company. All right, you use it as a fair price. So that after all these calculations, right? After all these calculations, so let me delete these few cells here. So the equity value. So that means it is the I think I have pressed some numbers. Oops. Then I have hide the toolbar. Let me close it and open again. Okay, yeah, the toolbar is back. All right. We are using the discounted cash flow method to find this value. All right, it's the fair value for the company. Okay, from that, we divide it by the number of shares. Okay, so this is the total number of outstanding shares. And we will find the value per shares to be 167.62. So this is our expected fair value. All right, so this is the expected fair value. So that means if we believe all our analysis are so accurate, so these numbers are exact, this will be the case. Okay, so that in the future, the companies will perform just as like what we expect, like this. All right, so that is, we believe we are true, we are correct. Unlike at the very beginning, when I mentioned that, well, if it is getting further and further away in time, our analysis will be less and less certain. Okay, we have high error in that. So just imagine we have all this value exact, we have all this value accurate. Then this is the price. This is the price we should see in the market. Exact. Okay, this should be the price, exact price. This exact price means that if we look at the market, all right, when we look at the market, Tesla is currently trading at $173, 173 compared to our expectation. Our expectation is 167. That means now Tesla is overpriced. Okay, Tesla is overpriced. If I'm so confident with my own analysis, okay, then what I'm doing now is to short sell Tesla because I believe that the fair price should be 167, not 173. So currently in the market, it is so overpriced. It is so overpriced in the market. So what I do is that I will be short selling it. And this is my discretionary call. Okay, this is my discretionary call. But of course, well, in reality, we are not very certain about our values here. All right. So even if I'm a very good analyst, I cannot say that these values, so these input values in the tables are exact. Okay. So they must be the case in the future. I cannot tell that. I can't say that it is just that simple. So what happened now is that I may introduce some uncertainties in my estimation or some uncertainties in the values that I end up here. Maybe I have some error of positive and negative $10. So what if I have such an uncertainty? So the numbers can vary by a lot. So plus or minus $10 may be all right. So we'll see that there is a bound for our share value. So our bound will be the lower bound is negative minus $10, and the upper bound will be plus $10. So as long as this in within this range, I would say that the stock is fair priced. Okay, I would say the stock is fair priced, and compared to the current value 173. So that means it is within the range. Okay, it is within the range. So if I'm trying to time the market, if I'm trying to find an entry point to the market, then currently it is the stock is fairly priced. So I can I can enter now or I can just wait. So it doesn't really matter. So it means that it is my discretionary call. I'm saying that it doesn't really matter if it is within the range. But if Tesla continue to go up, okay, if Tesla continue to go up above 177, then to me, I would say that Tesla is overpriced. Okay, it is overpriced. I may want to short sell it, or if I have already got it, I may want to lower its weight in my investment. All right, I may want to reduce the weight, or you can say that I may want to take profit. All right, so this is my discretionary call. But after all, it is just depending on my analysis. So this is what I believe. All right. Or on the other hand, okay, if Tesla go below 157 and I'm planning to buy Tesla, then that is a very good time. Right. So that is a time that I should buy Tesla right away. So that will be a good entry point because I believe that Tesla should be built in between this range, and it is lower than the range, and it means that in the future, okay, if I'm correct, the market should revert to my expectation. The market should go back to my expected value, that is around 157. So it depends on your estimation. So if your estimation is accurate, you're more confident with your numbers, and in that case, you may want to uh, buy more or sell more confidently. Okay, so the sizing depends on your estimation and your risk appetite. So if your risk appetite is high, okay, so I just every time when I do investment, I just YOLO. All right, so I just all in everything that I have. So in that case, that you are very risk taking, and that is also your discretionary call. So your discretionary call is the call on when to invest and the size that you want to invest. So this is your investment call, discretionary trading. All right. So of course, there are many ways to do this pricing. So in order to get the fair price, you can do discounted cash flow, or you can do uh dividend discount method. So if you do this dividend discounting method, you can so go back to the original tutorial solution that they use several companies. You can use this dividend discounting uh the expected dividends and calculates the corresponding stock price. So this is also another way that you can use. But of course, for some companies that are having zero dividends, then it may not be that straightforward in that case. All right. So this is one way that we can base on some pricing method in order to create a discretionary trading strategy. All right. And then this is the first question in the tutorial, and we move on to the next one. The next one is based on a paper. Okay, it is based on a paper published by these scholars. It is already published. Okay, it is not no longer forthcoming. I think it is published in 2018. So you can download this paper from Google. So you just search Buffett's Alpha and these three names, and you should be able to find the corresponding paper. So they are trying to analyze Warren Buffett. So Warren Buffett's investment. Okay, so his investment company is called Berkshire Hathaway, right? So this is a very famous company. So and it is well by the dollar amount is I think it is almost the highest one. All right, but of course, we shouldn't be analyzing stock by purely looking at its stock price. Okay, so stock price is just the price per share. All right, not necessarily telling you the size of the company. So if you need to know the size of the company, you should be looking at the market capitalization. Okay, the size of the company, not just the price per share. Anyway, so in this question, what we are doing to do is to analyze uh, the spreadsheet and analyze by using a factor model. Okay, we're using factor model. Again, we'll be using one factor model, which is the CAPM, and we can use the Farmer French three factor model. Okay, so it is an extension on that, which is the small minus big and high minus low, and the five factor model we include the BAB and Q minus J. All right, it's the quality minus junk. All right, so let's look at the Excel spreadsheet. All right, when you download the Excel spreadsheet, you will see you are provided with some data. Okay, so total return of Berkshire Hathaway public stock from 13F. So Berkshire Hathaway is the company. Okay, this is the investment company itself. Um, and public stocks from 13F is a sub portfolio. So it is like a segregated portfolio coming out from the company. Excuse me. So that means it is just part of the Bashir Hovering. So it's like they make some parts of the Bashir Hovering tradable for external investors. So for individual investors, so that it is the public stocks part of the Bashir Hovering. And next we have the Heinz and Crafts. These two food manufacturers in the US, and they're used in the analysis in the later time. So I will talk about that later. And then what else we have is the Farmer French multi-factor models factors. So we have risk-free rate, market, excess return, and we have small minus big, high minus low, quantity minus junk here and there. Okay, so we'll be using these numbers in our regression analysis. So we're trying to run the regression with one factor, three factor, and five factor. And before we run the factors model, we first need to calculate the excess return. All right, so compute yourself. So how do we do the computation? Very easy. So just the real the total return minus the risk-free rate. Okay, so this column is the risk-free rate, and that is okay. So that is, and we just copied it to the remaining cells. Okay, come on here. All right. So this is the full list for the shareholder rate. And next is that we have to do this for the other companies or for the other investment options. So to be careful, when you run regression analysis or when you copy the Excel formulas, you have to be careful about missing data. Right? For example, this public share starts in 1980s, all right, not from 1976. So the first return we have is from 1976, but it is from 1980s. So do not start at 1980s, all right. And I subtract this risk-free rate, enter, and copy to the remaining cells, and have a check at the end. Okay, so these two columns go to the bottom, and that is good. All right, so we just keep it at the bottom. And next is that we go to Heinz, and here we have this one minus risk-free rate. When I click enter and try to copy it, all right, I just copied it, and it is not a good idea. All right, so I have to do a checking. So this is the column for Heinz, and then it doesn't go to the bottom. It ends in 2013, but we still have some numbers here if I just simply copy it. All right, so it is not that clear. So we just see some numbers, but well, that is not very good. So what I'm going to do is that I'm going to delete it manually, right? Because if I don't delete it manually and I use it in the regression analysis, this will include all the zeros for me, okay, for me in the calculation. These zeros or these values, they're not supposed to be in the regression analysis. These are the missing data, so I should remove them. So no matter you're working in data entry, data analysis, big data, or even data scientist, so you're going to spend most of your time in working with polishing data. So you have to clean the data and be careful not to include those missing data, missing values. And then next is the last one. So we start here. Okay, we start here and we have to do the calculation right here. And we copied it to the remaining cells and delete the missing data. Okay, delete the missing data points. And that is what we should do. All right, so this is how we completed the calculation for the excess return. All right, so be careful. Whenever there's a missing data, whenever there's missing value, just do it accordingly. So a better way is that we count. Okay, we count all these numbers and see if they are the same. All right, so we try to compare, we try to compare these values. So 485, good. 444, good. 435, good. 164, good. All right, so this is a very simple checking for that. Because why I need to use count is that in real data, okay, in real data, there may be some missing data in the middle. Okay, in real data, when you download it from Yahoo Finance or any other financial console, it is possible that you have missing data in between, and that is more tricky. Okay, so there may be some in between. So that's why it is always good to do some count on your data set. All right, so this is just the first step. Next, we are going to run the regression, and we are going to use the function uh, LINEST again. All right, so that is the regression model, linear regression model that we use on the calculation. And let's see. Okay, so in the first regression model, all right, so we use LINEST. Okay, and the input will be the Bashir-Hoff rate, all right, and then sorry, not the Bashir-Hoff rate total return, but the excess return. So be careful. Okay, we use excess return, and then we are going to use the market excess return. So we have to align it. So if we start here, we start here, and then the last one, we use the last one here, and then if I just hit enter, we have only two values, but of course we need the constant and we need the statistics. All right, there we go. So if you still remember, the first column is the beta and the alpha. Okay, the output of this. The first one is beta and alpha. The second one is the sum of is the standard error. Okay, standard error of these two values that can help to calculate the significance of these two values. And then we have the R square. We have R square and the sum and the standard error of the regression. All right, and then we have the F statistics, degree of freedom, here and there. So, but anyway, so the most important are the first few values. All right, and it is in reversed order. So this one is the market, all right, and this one is the alpha. Okay, so that means in this analysis, we find that it has a lower beta than 1. Okay, so the beta of Warren Buffett's portfolio is lower than 1. It means that it's less sensitive to the market portfolio. And on the other hand, when we look at the alpha, so this alpha is time sensitive. So what I mean is that the time or the returns of these values are monthly data. Okay, when we use monthly data, our alpha is a monthly alpha. So we have to calculate the annualized one. Okay, annualize the alpha, just multiply it by 12. Very simple. So it is 13.4%. Okay, it's 13.4%. And but the beta is not time sensitive. Okay, the beta is just a ratio. So ratio is not related to time. So whether you use a annualized return or monthly return, it shouldn't change. It shouldn't be a big problem. Okay, there's no adjustment needed. But the alpha is. So there are 13% of returns in Warren Buffett's portfolio. And we are going to repeat it. Okay, repeat this analysis. And by changing to different rows. All right, so for the cave row, okay, the cave row is the market return, and then we are going to extend it to a 3-factor model. So that is including the row, the column M. So I change it to column M, and this is the result. All right, and again, remember the feature of this function is that from right to left, it is the alpha. Okay, it is the first factor. Okay, it is in reverse order. Okay, and then small minus big and high minus low. All right, so it is in reverse order. So if we input market as MB HML, then it is in a reverse order. Market as MB HML. And so again, we calculate the annualize the alpha. Okay, so it is 11.61% if we use 3-factor model. All right, what if we use the, okay, 5-factor model that we extend to 2 more factors. So these are the factor, and what's next is the Q minus J and EAB. All right, and the annualized alpha is 5.2%. All right, so what we can see here, okay, what we see here again is that for the market beta, it is keep on a relatively low value. So what I say it is lower value is because when we talk about beta, it is the market relationship. Okay, so the relationship to the market. If it is lower than 1, it means that it's less sensitive to the overall market movement. And this is the case for most of the hedge funds. So hedge funds are usually trying to just capture alpha rather than the beta. So you can always buy the market index to get beta. All right. So this is one thing. And the other is that we find that the alpha is high, right? The alpha is high, 13.4% if it is 1 factor. And so another interpretation for the alpha is that the alpha is the unexplainable return by the model. So just like here, if it is a CAPM. So CAPM, we can explain some of the return, but there are some return, 13.42%, cannot be explained that, okay, because this amount of return is not in the model, all right? It is by Warren Buffett's own discretionary trading, okay, his own view, Warren Buffett's own view, and it cannot be explained by the market, okay? So when we do linear regression, it is like doing some explanatory models, all right? We try to explain some values. So the goodness of explanation is provided by the R square. So R square, this value is less than 20%. So it means that less than 20% of the movement in Berkshire Hathaway can be explained by the market. All right. So there is the movement of that. And when we use more factors, so you will see the R square improved. Okay, from less than 20 to 25% to 29%. All right. If you still remember what I've mentioned in last tutorial, I said that most of the linear regression models are having an R square between 20 to 40% most of the time. All right. Some worse model may have even single digit, but the best model can be only as high as 40 to 50%. That is already very good. All right. That kinds of model is already very good. Um, but for 20% or less than 20%, it is just merely usable. Okay, it's just merely usable. And 25, okay, 30%, it is quite good. All right, so in real data, all right, if we're using real data, um, 30% it is already quite good. All right, if it is 40%, then it is very very great. Okay, for real data, for real market data. And anyway, so why it is having a higher R square is just because we are using more and more factors. Okay, so even if you use the temperature as a factor, okay, the R square will also increase. So this is just you introduce some other uncertainties in your model, and the model is getting bigger and bigger, and it is not the best way to get a R square higher by introducing more factors. So um, try not to think in that way. All right. Anyway, so we go back to the interpretation, right? We go back to the interpretation of these models. What we see is that the alpha is keep on at a relatively high value, so over 10%. And suddenly from this model jump to this model, the alpha is lower. So what it means is that there are around 6% of the return in alpha can be explained by these two factors. All right. So that means when we use these two factors, we can explain more unexplained return. So alpha is some unexplained return. Unexplained by the market, 13%. Unexplained by these three information, still we've got 11%. Unexplained by these five factors, that lowers to only 5%. So that means some of the factors are explained here. So one of that is the Q minus J. So you can pay a little bit more attention to this Q minus J. So because the beta is higher, and Q minus J is the quality stock minus junk stock. All right. So that means maybe Warren Buffett can detect what companies are quality stock, what companies are junk stock, and try to make money out of it. So this is his discretionary idea. He is good at identifying what stock means quality, what stock means uh, junk. Okay, and so this is the preliminary comparison of the models, right? Preliminary comparison. And then what's next is that we are going further into the analysis of the public stocks. All right, so we do the same thing for public stocks, but in that case, of course, you may ask a question that is, we have different observation period for Berkshire Hathaway as a whole and the public stock here. Okay, so we have some missing data for public stocks. So if you want to do a fair comparison, of course, you should run the regression again with the same observation window. Okay, so you should try to use the observation window and compare the results. All right, so but in this case, we have from 1976 to 2017, so there's a 40 years of time. So if you just compare it without 2 or 3 years, the difference may not be that significant. But of course, that is if we have that in hand, so then we do not need to really make an unfair comparison. So we can try to make the comparison as fair as possible. So we will rerun, okay, we'll rerun the regression from 1980, 1980s of April to the end of the data set. Okay, we'll run the regression again and make a fair comparison. And by making this fair comparison, you will find that the return or the Sharpe ratio or the alpha of the public stock will be a little bit lower. Okay, it will be a little bit lower, and it may not be easily explained. All right, so one thing that you can think of is perhaps it related to the liquidity. All right, because the sheer Hawthorne rate itself is a hedge fund company, and you cannot trade it from time to time, but only the part that have the public shares. So that is one of the reasons that the return may not be as high as the company itself. And there are some others. Okay, so there are some others, and but there's no concrete answer for that. There is no concrete answer. But anyway, so next we will continue to run some data analysis on the other two companies here, and we try to compare for the uh, similar uh, similar financial ratio. So earnings per shares, book to market, debt to price, here and there. Okay, so we try to rerun the regression for them, and I just want to for this comparison, I will leave it to you to do because it is quite straightforward as long as you have done the first part. And one thing I want you to pay attention is that so you can try it by yourself. That is to read the annual report. So this annual report is filed to SEC in US. So because they're a US company and they have to file their annual report regularly. And if I open this annual report, you'll find it is hundreds of pages. So it has over hundreds of pages, over hundreds of tables here and there. So I'm still scrolling. So there's so many information there. There's so many information. And we are trying to extract just a handful of numbers that are needed in our analysis. All right. So because we just need to calculate these financial ratios and only a handful of numbers that you need to do. That is in the solution, it has provided you that where you should find the numbers. All right, for example, in this table. All right, for Heinz, the price is provided, and then we have the SHOUT. So I don't like this that much, but it is not shout. Okay, it is not shouting out loud, but it means the share outstanding. So it is the number of shares outstanding, or some shares that are available for trading. And from that, okay, so it is page 33. You can use it to calculate the market cap, right? So this is the market cap. So the size of the company, so it is over billions. Okay, so it is 19 billions company and quite a large company. And you can also get the book equity from page 35. Mostly, let's check. It is from a financial statement. It is from the income statement. All right, it is from the income statement, and it provides most of the numbers that you need. And what you need to do is just to extract the numbers that you, well, just a handful of number, just a few of them, but from these hundreds of pages. So you just search for the income statement, search for balance sheet, and search for, yeah, just the balance sheet. Okay, so these two are the most important financial report that you need in most of the analysis. All right, and it's just a preliminary analysis after calculating this or that, and you can start your discretionary analysis. And if there is anything that is special, then you go back to the annual report. and try to find out, go go deeper into the explanation and go deeper into how they get the numbers. Otherwise, most of the initial analysis are based on the income statement and the balance sheets. Okay, so yes, so I think I will leave that to you. Okay, and yeah, I think that's all I want to talk about today. Any questions? Yeah, you can type it in the chat box or send me an email anytime. So yeah. So if no other questions, then it will end our tutorial today, and I will see you next week. Thank you.